My name is Scott Ryrie, AM Best Singapore, and it's my absolute pleasure to not only welcome you to Singapore, to the hot and humid, nearly on the equator city-state, but also to welcome Greg Carter, who is the AM Best Head of Analytics for EMEA and Asia Pacific. So Greg will present to you today on innovation, which should be top of mind for everybody, and quite exciting times. So Greg, over to you.
Thank you, Scott, and thank you particularly for getting out of bed so early. It's me or the pillow, and I'm glad to have won the battle with at least some of you. So I just want to start off by saying there will be time for Q&A afterwards, so if you've got questions, please do fire them my way. I plan to talk for about 35-40 minutes in total. So if anyone needs a coffee to keep going, now's the time to get it. And so let's kick off. So I'm here to talk about the role of innovation and the impact it has on insurers, and particularly how we as a rating agency will incorporate that recognition of innovation and the efforts that are being made across the industry, how that will have an influence on the ratings. Last year, we conducted a pretty extensive survey on the subject of innovation. We got responses from more than 450 companies in nearly 50 different countries. A real mixture of companies as well. About 2/3 of those companies were property casualty or non-life companies, as we Brits like to say. About 10% of them were reinsurers, and the remaining 25% or so were life and health companies. And it was a real range from some of the large multinational global players down to some very small regional or specialist players. So we think that the results of that survey are pretty comprehensive. It provides a good sample size, a good window on the industry in terms of what's happening with innovation. So what I'd like to do before I talk about how we've incorporated innovation is to focus on just a couple of the key findings from that survey. I'm just going to talk about 4 of the questions that we asked, because I think that sets the scene for how the industry is responding. So we asked the industry what was the primary reason innovation is important to their organisation. And what you can see, there's quite a mix. This is a single answer per company. So there's no clear driver of why companies are investing in innovation. And the top 2, I think, are somewhat similar in terms of addressing customers' needs and gaining a competitive advantage. I think many companies realise that technology is changing so rapidly, and partly as a result of that, the needs of customers are changing so rapidly. There is a great urge to stay close to the client. The way that insurance is bought and sold has changed radically, certainly over the last 20 years, but probably more so over the last 10 years. And if you go back longer, insurance was something that was typically sold primarily through brokers and agents, and there were very few other channels. Nowadays, people are using mobile phones, they're using apps on other devices, computers. There's a whole range of methods of reaching clients and methods of clients doing research on which insurance company to be with. Traditional methods of advertising no longer apply in that world. So companies have to think very differently about how they present themselves. And social media is having a rising impact. There's a perfect example, not an insurance example unfortunately, but in the banking world. Anybody that's followed the story of UBS in the last week or so can see the impact of what may have appeared as a fairly innocuous comment from their chief economist about the state of the Chinese economy was picked up on social media and has created a real storm in China. And UBS have spent years investing in China. They've only recently been granted the appropriate licenses for retail business. And they've made huge strides, and almost overnight that is put at threat. And that's all, it seems, seemingly because of the social media backlash. And then when you consider things like life insurance, traditionally it's a product that has been sold. People don't wake up in the morning and say, hey, I need life insurance today. It's always been sold It's always been pushed at, and often at a key point in a person's life, when they're getting married, when they're having children, when they're buying a house. Well, society is changing, and the way that people live their lives are changing. The rise of the gig economy, and people doing multiple jobs or part-time jobs, or spending some of their time working and not working, changes the fundamental needs for insurance products. And the industry needs to respond to that. And then one of the other key issues, when it comes under the topic of realising operational efficiencies, there's certain aspects of this industry that are perceived to be hugely expensive and inefficient. The reinsurance market carries expense ratios of typically close to 40%. And that's a market that's been quite stagnant in terms of top-line growth. It's had an excess of capacity. And one of the few levers that management have been able to pull has been to focus on expenses. Now, you can argue for reinsurance, actually, that 40% doesn't truly represent inefficiency. There's a lot of value added that goes into that compared to, say, a primary domestic insurance policy. But there's clearly a strong push to take costs out of the business. And many businesses are also dealing with significant legacy systems. So if you're holding a lot of information on life insurance policy holders, you've got a lot of personal sensitive information, you've got significant challenges in terms of moving your systems forward and using that data. And that's one of the big drivers for companies to look to innovate. So we then asked what were the three most important challenges that innovation can help with for insurers. And there is a bit of a clear winner on this one in terms of systems, processes and inefficiencies. So that comes back to that point of driving cost and expense out of the industry. But I actually think this is quite an interesting contrast to the previous slide. So we asked the primary reasons that people think innovation is important, and it's very much focused on the consumer, the customer, getting closer to them, making it easier for them to do business. Yet the most important challenges seem to be about systems inefficiencies and disruptions to the business model. So I think that shines an interesting question on why companies are involved in innovation, why they're devoting time and effort and calling things innovation. Many of the management that we talk to do highlight their existing systems as a very significant drain on their resources, both human resources and financial. And as the pace of change increases, having systems that can keep up with that and evolve as products change is a huge challenge for the industry. And the numbers that get spent in terms of maintaining systems are mind-boggling. There's also the challenge that we see in many markets around the world, the rise of consumer concern about their own data and the rise of privacy laws and data protection laws. And that presents great challenges to the market, just simply to stand still with the regulatory requirements. And I think those companies that are able to move with that and to leverage issues such as big data do stand to take a lead against other companies. And I think the industry sometimes doesn't have a great reputation for innovation, but we already see in a number of areas innovation making big changes. Just simple things to take out costs and to improve, to reduce fraud. The use of self-risk inspection, people using their own mobile phones to beam pictures of the property that they're insuring, saves a risk inspector coming out. So it's simply taking cost out of the business. It's not radically changing it. And then the growth of cyber we see as a big opportunity for companies. Clearly it presents a threat to all parts of society, but also to the insurance companies. But those companies that can write cyber insurance risk have a big market that we've seen significant growth in. But of course there's no history of cyber losses, no long history of cyber losses. And the risks that give rise to losses seem to evolve very rapidly. So we then asked what approach best describes the firms that we surveyed. And the good news, I think, is that for the top two categories, that covers most of the respondents, this is an industry that's clearly taking innovation very seriously. And that gave us comfort that actually we'd chosen the right time to conduct that innovation survey. It also drove us to then develop our innovation criteria, which I'm going to come on to in a second. But one more question that's relevant is, what do companies see as the important challenges? So they're all concerned about it, they're all doing something about it, it's in their strategy, but what do they see as the important challenges? And here, I think, is one of the big issues for the sector. Talent that comes out as the top challenge for companies. This industry does not have a reputation for being exciting and dynamic. It is not sexy. And if you look at surveys of graduates and the millennials, insurance is not an area that is hugely successful at attracting that talent. And that, I think, presents a huge challenge for the sector. So when you put together some of the key structural changes, we've grouped them into three main areas of demographic shifts, climate-related trends, and technology. These are all things that are changing rapidly. People are more aware of the changes, and the pace of change seems to be increasing. And that's got to have an impact on the financial strength of companies. You put those together, it's going to impact the financial strength and success of companies. And what our plan has been through this survey is to better understand how companies are addressing innovation and how they plan to adopt to that changing environment, and then measure the impact that that's going to have on the financial strength. So how should that factor into our ratings? Now, the reality is our ratings have always recognised innovation to some extent, and I can give you examples in our building block methodology, which I hope you're all familiar with. The first four building blocks are the key drivers of our rating, and you can point to innovation within any of those areas that has an impact. So a life insurance company that gets closer to its clients, develops better products, understands clients' needs better, can improve its retention. And it can increase the expected lifespan of a company. And that can have a huge impact on the balance sheet strength when they've made key assumptions as to how long policyholders will stay with them. A company that drives out inefficiencies in their business, in their processing, are going to improve their bottom line. That'll have an impact on operating performance. A company that's able to get closer to the clients or steal a competitive advantage will win more clients. It will improve its market share, and that will be reflected in the business profile. And companies that make use of technology, big data, and better processing techniques can better understand their risks so they can improve their enterprise risk management. So at the moment, we could point to innovation affecting any part of our rating process. So what we try to do is to try and bring that together and say, well, let's put a structure and a framework about how we measure and assess innovation. So really we need to start with, what do we define as innovation? And really what we've said, I've seen lots of different definitions of innovation, so I'm sure there'll be people in the room that disagree with this. But we think this is a good way of describing innovation and how it applies to our rating process. We think innovation is a multi-stage process that transforms ideas into new or significantly improves products, processes, services, and business models. But that has to have a measurable positive impact over time. And what we also recognise is it doesn't have to come from within. It can be companies utilising the best technology in the world or partnering with others that are moving forward and creating innovative solutions. So we think that for innovation to be successful for a company, it also needs to be dynamic and ongoing. It needs to be a result of a long-term commitment. So, how do we go about scoring innovation? It's quite a tough subject, because if you can't even reach a broad consensus on the definition of innovation, how do you then measure it and define it? So I think what we've started with is we would regard as a a pretty simple to understand framework. We already found this topic, although the criteria has not yet gone live, the topic comes up with all of our companies that we interview, and this criteria now provides a very good framework for understanding and measuring that. So we've got a fairly simple process. To measure innovation, we have an innovation input score, which is really about measuring the components of a company's innovation process. And we add that to an output score, which is really the impact of the efforts that those companies are making. And that comes up with an innovation score. So let me talk a little bit about the components of that process. So the innovation input scores are based on 4 key areas of leadership, culture, resources, and processes and structure. And we score each of those elements on a 1 to 4 basis, 1 being the weakest, 4 being the strongest. So the sharp mathematicians in the room, I probably have already worked out that scores on this element will range between 4 and 16. So let me just talk about what we mean by each of these components. So leadership is one of the key drivers of success. If there isn't leadership on innovation, the other building blocks will not score highly. It does need buy-in at the senior level. It's a key driver for the culture, and there is a difference between leadership and culture, which I'll come to. So without that strong leadership, you won't create a strong culture of innovation. Without that strong leadership, companies won't be devoting the resources to drive change. And without a lack of strong leadership on the subject of innovation will not create the appropriate processes and structures for success. So companies scoring at the lower end, the 1s and 2s of leadership, are companies that really don't recognise innovation as key to their critical to their success, not a core part of their strategy. For the companies scoring 3s and 4s, we expect them to be demonstrating that innovation is accepted and a key part of the objectives of senior management and middle management right throughout the organisation. So culture that inspires innovation is also a culture that accepts failure. I worked for a company a few years back that had a strong culture of innovation. They were willing to take risks. They had a number of people running various initiatives, but they were told from the outset that we expect 50% of those initiatives to fail. And that's quite a good number, because if you're part of an initiative that fails, you know that actually you're in good company. You're not going to be singled out. And the company's view is also, if 90% were succeeding and only 10% were failing, then people weren't taking enough risk. They weren't being innovative enough. So that targeting of 50-50 was just the sweet spot, because it encouraged people to say, well, okay, I will take a risk. And senior management would often push back and say, are you being risky enough? Are you taking enough of a chance? And that company, during the time I worked for it, I'm not saying that my input was a huge factor in it, but that company grew very rapidly during that time. And some of the things it did failed, and some of the things it did were hugely successful. And the successes more than paid for the failures. So the companies that are scoring high in this area have a real purpose and a systematic approach to innovation. They encourage that failure, well, not encourage failure, but they accept the failure, but they encourage the sharing of knowledge and experience from those failures. Innovation is truly embedded within the organisation, so that well-defined tolerance for risk-taking, and they'll step in when initiatives are failing and pull the plug rather than persist with things that are not working. And for those companies to score at the higher end, they also need to be open to external ideas. It's not all about having a chief innovation officer internally and driving all the growth within the company. It can be looking around at you, at competitors, at different industries and saying, well, how can we leverage that? How can we take the step forward that another industry has made and apply that to our business? And when we're interviewing companies and we see that, we really expect to see concrete examples of how companies are doing that. So as I said, that leadership, the strong leadership, will drive the appropriate culture. And you're not going to see companies with a high culture score unless they've got a high leadership score. The third area is resources. And again, a strategic allocation of resources is key to success. Now, many of our clients are relatively small companies, particularly across our US portfolio. These are small companies that don't have an awful lot of free capital lying around. They don't have a deep management team. So for them, innovation is quite a challenge. And for those companies, actually, we feel it's probably more appropriate if there's certain areas that they would focus on. So they may focus on different product design. They may look to leverage other parties. So outsourcing of key elements and leveraging the opportunities that are emerging elsewhere may be the most innovative things that some of those smaller companies can do. So our methodology doesn't discriminate against the companies because they don't have a team of scientists or programmers or developers that can create new products. And we define resources as technical, creative, or financial. So technical is, do companies have the appropriate systems? In terms of creative, do companies have the right talent? And as I highlighted earlier, one of the key challenges for the sector. And also financial, does the company devote an element of its budget to innovation? And does it manage that carefully? Does it refocus its efforts? So again, the companies that are scoring at the higher end, they've got systems that are not just fit for the purpose today, but they've got systems that can adapt to that evolving industry. They've got the ability to recruit and retain the talent that's required, and they reward that talent appropriately. And they commit the finances and manage that process well. And then the final element of the input score is measuring processes and structure. And we think proper data management is absolutely a key building block to successful innovation. Without proper process and structure, innovation initiatives are not going to succeed. And companies really need to focus on data quality and defining ownership of that data. Now, one of the challenges, as I highlighted earlier, is the evolving regulatory landscape. And that can be regulation within the industry or general data protection laws that present huge challenges for insurance companies. And once you start to focus on that, you then stray more broadly into the governance of a company. And this is an area where we are seeing more companies outsourcing key elements of this process, partly to pass the risk to experts that have got broader experience. So when we put the 4 blocks of the input score together, as I mentioned, the lowest you could score is 4, the highest is 16. So where would we expect insurance companies to be coming out? Well, I think it may not be a very palatable message for any insurers that are in the room, but we don't expect the industry to be scoring very highly in this area. This is not an industry that has a strong reputation for innovation. That said, there are some excellent examples, and we are seeing a much greater focus and increased effort. And so what we may see in the coming years is the input scores start to rise as companies put in place the appropriate structures, they make that investment, and they start to gain some traction. But what we think may lag is the output scores. So I'm going to talk a little bit about that. For that, there's only 2 components, and that's focused on the results and the level of transformation. Now, we wanted the output score to be weighted equally to the input score. So again, we've scored these on a 1 to 4 basis. Add the outputs and then double the results. So again, you've got a range of 4 to 16 on the output scores. So to talk a little bit about the results and what we're looking for there, we look back over the period of the last 5 years, which 5 years ago the industry was very different. So we're probably more focused on the more recent efforts, but many efforts in innovation, they're not overnight successes. They're things that require a longer term investment. If you're really going to take advantage of better processing power and more availability of data, you've got to start collecting that data. You need to identify the trends and identify the triggers for that innovation. So a strong investment history in innovation may help you to score highly on the input, but it doesn't necessarily guarantee a high output score. So measuring the results is quite a challenge because there can be some quite subjective elements to that, but what we're looking for is examples, demonstrable results. So are companies genuinely producing lower expense ratios for others compared to others writing the same portfolio of business? Are companies generating higher revenue growth, not through simply turning the tap on, but writing more profitable business and taking a greater share of the market? Can we see that companies are demonstrating the development of products that are clearly more customer-centric, that have more positive feedback than traditional products? Can companies demonstrate a higher customer retention? And can companies point to a greater brand recognition? Are there innovation initiatives resulting in an improved brand profile? And I won't name names, but I think of one life insurance company in the UK that makes great play on its innovation. It builds itself as a market leader, as developing new techniques. Now, whether that actually materially results in better business for them or higher customer retention, it's less clear. But they've clearly marketed themselves as almost a sexy life insurance company. It's focusing on the younger demographic. It's using modern techniques to access clients, and it's clearly built a better brand in that sense. Whether it relates into financial output results in financial output is another issue, but they've clearly stolen an advantage with their brand. So those companies that would be scoring higher here, they have demonstrated sustainable competitive advantages, and it's having a measurable impact either versus their competitors or versus the disruptors, the outside influences of the industry. And then the final component of the output score is measuring the level of transformation. And really this is a question of how meaningful has the change been. We could see an example of a company, for example, that's digitized all of its policy record keeping. And they would point to that and say, we've taken cost out of the business, we've innovated. But in reality, they've simply kept up with what most of the industry has done. So they would perhaps see that as innovation. We see that as standing still. And key for us in terms of scoring highly here is we have to see that the innovation gives a longer term advantage. A one-off hit that either boosts revenue or takes costs out of the business over the short term may have taken several years to achieve, but if it lasts for 3 months, that's not providing a sustainable advantage. So again, sadly, on a 4 to 16 range, we'd expect many in the industry to be scoring relatively low. So how do we pull that all together? Well, we add the two, the input score and the output score. And from the range of now 8 to 32 as possible outcomes, we tranche the results. And the reality is, as we start to work through this, we don't expect to see many companies being regarded as innovation leaders. We've set the bar there as 27 points out of a possible 32. I don't think we'll be seeing many companies recognised as innovation leaders. There will be some in the innovator category, but we think that most of our client base will fall into the adopter and reactor categories. So just to give you one sort of brief example of how we would apply the methodology, we've got a fictitious company. It's a medium-sized mutual motor writer in the Midwest. I think we've got plenty of those in our portfolio. Management of this company has recognised that innovation is critical to the organisation. They make that very clear when employees are onboarded. They reinforce that at every opportunity across the staff. They've got a number of initiatives underway. They're working on expense savings through centralising a lot of processes. They're using data from telematics from their core portfolio of motor to try and understand risks better, to innovate new products. They think they've been ahead of the curve in implementing this compared to the local competitors. And what we've seen as a rating agency is that their annual expenses have decreased and their net operating income has increased. And they can point to that and say that they feel that that's been a direct result of what they've done. Now, some of the challenges that we saw when we interviewed the company was that tracking the budget for this initiative is a bit fluffy. They can't be absolutely clear as to which of their expenses is going on this task. Their transition to new software to leverage that data is behind schedule and it's overrunning with costs. And they haven't really been able to explain to us the true costs of this initiative. And then recently they've lost a key senior person within their IT team who's been driving a lot of this transformation. So how would we score this? Well, I think from a leadership and culture perspective, there's clear evidence that they're pushing strongly on innovation. They get that message across. It's a core part of their strategy. It's written into what they do. But in terms of resources, their process is now delayed. They've lost one key member of staff, and that's blown them off track. And their processes and structures, well, they're still not clear on certain areas, so we score a little bit lower. So in that case, our innovation input score would be 10. Now, in terms of the output, well, again, not scoring very highly. Now, there has been some expense saving, there has been some improvement in bottom line, but we're not sure that they can replicate that. That may be a one-off change, and there's a risk that their competitors will catch up. They've adopted some new technologies, but they're still relying on legacy systems. So there's still a lot of work to be done there in terms of demonstrating that transformation. So there we've scored 2 on both categories. We add those together and double them to come to an innovation output score of 8. So for this case, we come up with 18 as the innovation score, which falls firmly in our position of adopter. And I think if you consider the scenario I explained, I don't think anyone would regard that company as a true innovator or innovation leader. So adopter seems an appropriate key word. And what we plan to do is, within our publications, is to describe the company's innovation initiatives and then summarise with this key word. So there will be several companies as adopters scoring slightly differently, but we feel grouping them at this level of granularity is appropriate at this stage. So how will it impact ratings? Well, we think innovation is hugely important for companies, but will it impact ratings? Will it change ratings? We don't think so at this stage. How will we recognise it? Well, we'll put it into one building block and into the business profile section of our analysis. And business profile does pick up a lot of those slightly more subjective, less quantifiable elements of measuring a company's financial strength. And over time, we do think that the impact on ratings will increase. We will, at some point, see ratings change because of the impact of innovation. So that brings me to the end of my presentation. We do have a microphone for questions. I must point out that the survey that I've spoken about is available outside. It is also available online on our website. And the draft criteria is also on the table. That's currently not available online, and the reason for that is we've been through a consultation process. We've received lots of feedback on the criteria, and I'm pleased to say mostly positive. Pleased to say that we've taken the initiative in terms of addressing innovation. The process for us now is we take on board those comments, and later in the year we'll come back out for a final consultation on a revised criteria for measuring innovation. And that will then get finalised and adopted and formally incorporated into our rating process starting in the first quarter of next year. So when that second wave of consultation comes out, I would encourage you to read the criteria at that point and provide us any feedback that you have. So with that, I'm happy to open up to questions. I think we've got somebody with a microphone. A question at the back there.
Yeah, hi. Jane Corner with St. John's University. Greg, I find that you have background working with the S&P and Fitch ratings, etc. So when it comes to, say, evaluating rating results by agencies, we have, say, some high level of confidence in comparing, say, ratings across the agencies. Now we are talking about creating a new rating for innovation. It seems to me, I do not understand the logics clearly and methodology either, but it seems to me there are some subjective elements in this rating methodology. So what is your vision or AM Best vision regarding the comparability of AM Best innovation rating with, say, the ratings of similar agencies or from agencies outside the financial services sector?
Okay, good question. I think firstly it's important to highlight that we're coming up with an innovation rating. It's a score of innovation, and it won't be a separate rating. We won't call it a rating with a AAA type designation. It will be a component of one of the building blocks of our rating process. So it will influence our ratings.
I see it then. Okay, allow me to rephrase my question. So what does 18 means to other rating agencies or to your clients?
Sorry, what does?
Say, in your example, say the rating score of 18.
Well, in that...
Again, say when it comes, for example, like A++, and then like a AAA, and say and other ratings, we have relatively clear idea about the comparability of those ratings. So if it comes with like a rating of score of 18, and you classify it as an adopter, how can we do the comparison of your definition or classification of, say, adopter or 18 with say, possibly say similar approaches by other rating agencies or in insurance or elsewhere?
Well, I think it's probably fair to say we wouldn't necessarily say that there's a correlation between AAAs and being at the higher end of the scale. I think there may be some correlations, but there's not a direct translation from scoring highly here to being a AAA or AA on the final insurer credit rating.
Pardon me, my question was very, very unclear. Okay, I'm causing some confusion. I have seen initiatives by other companies, other organizations to come up with their own rating systems for innovation. Now they're coming up with their own systems, their own scoring systems, and I'm looking at your scoring system and your classification of the clients into the 5 categories. So I want to compare an outcome of yours with an outcome of another institution. How can we build somewhat reliable correlation of the 2 or more organizations so that we can see that our innovation leader of AM Best is similar to something else by, say, S&P or Fitch Ratings or ABC?
Well, I think it depends whether we're comparing and looking at the same thing. Are we trying to measure the same thing? And what we're trying to measure is how innovation is having an impact on the financial strength of the insurance company. And how that impacts, as I said previously, you could point to innovation as having an impact on almost any part of our rating process, any part of the financial strength assessment. So this is just an attempt to bring that into one area and to describe it on a fairly simplistic scale. Now, what those other companies are doing, and not just rating agencies, other entities observing innovation and scoring innovation, well, it depends what they're trying to measure. Because if they're looking at a bank, they may be looking at their ability to generate revenue rather than talking about financial strength. So I think it's going to be very difficult to compare and produce some sort of mapping across from an innovation score to a third party's assessment. Now, they may correlate, they may converge over time, that's possible. But I think at this point, we haven't focused on what those other companies are doing. Our view is to say, well, within what we do, producing a financial strength rating of a company, where do we need to look at innovation? How do we need to bring that together and define it? And I'm not aware that S&P and Fitch and Moody's have got specific innovation criteria as yet. So I think we've taken a lead in saying, well, this is a difficult subject. It's a very subjective area. This is a framework that starts to pull that together and say, how should we be looking at it? How to compare that with others? That's beyond my pay grade. It's not our job, and that's maybe something for the industry to comment on.
Good morning, Greg. Thank you very much for explaining this. One thing that struck me going through it is a matter of resources and skills, and I guess a lot of people at the rating agencies are used to looking at financial data. Are you going to be supplementing your skill base to be able to make these sort of assumptions, or is it going to be just the management interview approach? Because it's a massive area. Insurance companies are living in two worlds at the moment, the old world and moving to the new world. And I think you might have to get, I know it's subjective, but more experience to be able to make these subjective decisions.
Yes, it's a tough area to measure the input or the value that is being provided by individuals within an insurance company. I think the focus on the output will demonstrate whether companies are getting the right people in. I don't.
I explain again. So what I wanted to know is what AM Best is doing about getting the resources to be able to make these assessments that can't just be the financial traditional our business is being challenged with. So will you be getting people inside AM Best who have this knowledge and ability and have worked in these situations?
We do have a few people that have come from sort of tech backgrounds, from sort of non-traditional backgrounds. We don't think that we need to invest heavily in bringing in tech specialists or innovation experts, because a lot of what we do is we're making an assessment of whether an insurance company's management can demonstrate that they understand what they're doing. Now, it's not for us to audit what they're doing and to test out the skill sets of the individuals that they employ. The proof of the pudding is can you see that the innovation is embedded within their organisation? Can you see that it's having tangible results? So we feel that we don't need to relocate to Silicon Valley and to start wearing jeans and t-shirts every day, but we can talk to management about what the tangible output is, and we can interview the staff and see whether it's having innovation is being embedded and whether that culture is changing. So there's a certain amount of training that our analysts need to go through, and my team have been trained on the basics of this. And over time, as we develop the criteria, I'm sure that we'll get a better feel for that. Any more questions? One right at the back.
In the last 5 years, since you've been managing the process, do you see a place where customers will have the largest gap and then alternatively the largest strength in innovation?
Sorry, customers?
Or the companies that you're working with that you do. Have you seen an area that you can identify that will be the most difficult for companies to adopt innovation or be a leader in innovation? Alternatively, where they're
I think probably one of the biggest challenges that we see when we're talking to companies is the struggle with legacy systems and moving away from the existing processes and systems. I think that's probably the biggest challenge that I've seen talking to mainly the large European companies. Particularly because many of the companies that we rate, particularly the larger companies, have come together through consolidations and acquisitions. And this is an industry where you do see a fair amount of acquisition, M&A activity. And companies absorb portfolios of business and often absorb old systems. And bringing that together, I think, is one of the major challenges because it's very costly. It brings all manner of risk, particularly that heightened regulatory risk that I've talked about. So I personally would see that as the biggest challenge alongside getting in the right talent. Because, as I said, this is not an industry that's regarded as sexy. It doesn't attract the more ambitious, the younger generation. So it's, and many of the systems and processes, the methods of working that insurance companies use, the tasks that are done, have less appeal to that younger demographic that's looking at the gig economy, that want to do multiple tasks, they want to work part-time, they want to take 3 months off. You can't be a client relationship manager if you work 12 hours a week and take 3 months off. So there's a fundamental clash between what many younger people want and what the insurance industry currently needs with its current business model.